Hey man, I just want to ask a quick question. Tesla was not invited into the S&P, and it smells like their accounting might have been a problem. Have you ever heard of that happening before? And where do we go from here, you think?
I have heard of that happening. Is there any questions with the accounting, or even if not, and it may not be accounting, it may be guidance. Do they trust you with your guidance? And that as well.
Mm-hmm.
Because the accounting is one thing, but remember the guidance is, you give out guidance before, it's like you can't tell them outright, but you give some type of hint as to where things are, so that people can make their estimate, and then you want your accounting to come in to hit your estimate.
Mm-hmm.
So, but remember what I said, if they come in significantly ahead, if they consistently come in significantly ahead of earnings estimates, I could see the stock market, the guidance people saying, you know something, you guys downplay so much, we're not going to play with you. You know, it's one of those things, you know how it is, when you know, like when you're doing budgets, it's the same exact thing. When you're doing budgets, if you sandbag so much that you're so far under, they're not going to take you seriously. And
the thing right now,
that could be it.
The thing right now that's the big conversation is the problem that seemed to be the case is the S&P committee didn't like the fact that they were using EV credits, that money they were getting from others who don't build enough cars, to make their numbers. And it seems that the committee is not happy about that, is the only thing we can estimate. So they're not doing a profit before using, if you will, that funny money.
Oh yeah, and that's a big issue. Deferred revenues versus current revenues. When you're doing revenue recognition, that's one of the most important. That is one of the, if not the most important thing in accounting, is revenue recognition.
Okay.
And in fact, remember I told you about that trial that I testified at?
Uh-huh.
One of the big issues as to what I was going to be testifying against was a question on revenue recognition. And at the time, we didn't know, the CPA and I didn't know, so we had to do some research. And when we came back and said, no, you cannot recognize this revenue. And she wanted to recognize it, and she went ahead and had to put it into the financials, and sent it off to a bank to get credit. That's why it's that important. That's why that was one of the counts that she got convicted on.
So in this case, Tesla is getting revenue from, the EV credits where they're being paid, and if the issue is if it's being used under GAAP, generally accepted accounting principles, should it be a big deal?
It should be. See, that's the question. How are they doing it? Because it should be a wash. It should be an offset, in effect. Because that's one thing. You've heard the term net revenue.
Mm-hmm.
They should really be calculating what the true revenue is. Because in effect, those credits are not truly revenue. The credits are credits, so those go below the line. That's not factoring into EBITDA. So the EBITDA number could be artificially high.
So you're saying the S&P committee wants to see them generate a profit without using the EV credits, basically?
Right, because what happens once the EV credits run out? Are you sustainable? Are you sustainable without the EV credits? So the EV credit, so it should either be they do it as a reduction to revenue and an increase. It should actually be called other revenue or other income that's below the line, and as a result, and get calculated after you're calculating EBITDA, and so forth. You've seen financial statements. You see where they show other
I have,
other
but
income and other expenses.
I guess what
Yeah,
I was wondering
that's exactly
about,
what it is.
I was wondering about if they work with their accountants, and it's being recognized under GAAP as revenue and profit. Why should the S&P committee care? You know what I mean? If they're showing a profit that way.
Well, it's not so much are you doing it to GAAP. It's are you doing it to GAAP, but are you also doing it to SEC regulation? So when you look through 10K, they don't just put in an income statement and leave it at that. They put an income statement and then break it all down in so many different ways.
Mm-hmm.
The question that S&P may be saying is, why aren't you breaking it down this way? It's most likely it's embedded in the numbers, and they don't show a way for it to be broken out. And the S&P is saying, we don't like that. We want to at least be able to see where that number is so that we could pull it out from a true financial point of view. Because you got three different numbers. You got a financial as it pertains to the SEC, you've got accounting as it pertains to GAAP, and then you got tax. You technically have three different books.
Mm-hmm.
So like with and same person, well, with the Solomon Brothers, we had to map from financial to GAAP to tax, and we could show each dollar how it transfers as you shift it over.
Mm-hmm.
But if you've got something that's embedded, you can't do that. And I have a feeling, and without looking at it, I have a feeling that's what the SEC is complaining about. You see?
So repeat that again. Every company has three sets of books, and the way they're
it's not necessarily three sets of books. It's really two sets of books.
Mm-hmm.
But you've got enough data in there so that people can pull out the information so that they can pull up a different structure.
Mm-hmm.
So that, and that's most likely what it's saying is, you guys aren't being transparent enough. That's really what the question most likely is. Because if GAAP is GAAP, that's going to be the argument.
Mm-hmm.
But the argument's going to be, when I look at the financial statement, I look at it, like when I'm looking at acquisitions, yeah, I get it, and then I start splitting and dicing that financial statement all over the place because I want to see how much cash are they truly kicking off. How much are they doing here? What are they doing here? What happens if this happens? What happens if this happens? If you can't do that,
mm-hmm.
by default, that's an issue
mm-hmm.
because you've got a time bomb sitting in there.
Mm.
So
a time bomb in what? A time bomb in what sense?
Well, if you're turning a profit, but if your profit, how much of your profit is based upon the EV credits versus how much is based upon your continuing operations?
So
why EV credits can go away at any given time, in theory.
So the concern would be the EV credits could disappear, leaving the company in a bad position.
Right, and that's why it's the same thing that people do with stock prices. Everybody wants to look at the numbers on a fully diluted basis. When you look at stock on a fully diluted basis, which is looking at it, when you look at what the stock value is, they're looking at it based upon if all options were exercised.
Mm-hmm.
All options and warrants and everything were exercised, even if they're not exercised.
Mm-hmm.
That's looking at it on a fully diluted basis.
Mm-hmm.
They want to look at people, and that's some of the stuff that they do. Are they fully diluted? No. May they be diluted? They may never come in. But you want to know where you are, because in theory you're saying, what's the worst possible scenario? Mm-hmm. That's the full dilution. What's the worst possible scenario with EV credit? They go away. If they go away, how much of the revenue is going to lose? And then they start looking at it saying, okay, now if we could pull out the EV credit, we truly see what your cash from operations is. That's what people really want to know is, what is your cash flow from operations? Because if your cash flow from operations can't cover you, you've got a problem. And think about it this way. Enron and WorldCom,
mm-hmm.
and WorldCom more so than Enron. Enron played other games, but WorldCom was playing fast with the accounting with all these acquisitions, and the acquisitions was where they were getting their revenue growth. And I'm not talking the adding of the revenue from that, but also like how you accounted for the merger of the of the company and all this other stuff. So they basically in a position where they continue to have to do acquisitions because you're driving their revenue. Because the cash from operations was not working. As a result, it imploded at what you know what I'm saying. If you pile on at that level, you're already going to implode. So if your cash, so they really want to know most likely is what's your cash flow from operations, and then now we see what your cash flow from operations are. What is your cash flow from operations compared to your competitors as a percentage? Are you on target with them? Are you better than them? Are you worse than them? You know, and that goes to one of these, like Tesla's pushed so hard to be seen as not a car company but a tech company. So they want to get a valuation according to a tech company, not a car company. But at the end of the day, it's a car company. You see?
Wow.
So
the only way they're going to clean this up is if they're able to generate a profit without having to use those tax credits. Is that your sense of things?
yeah,
Wow.
that's what I would be looking for.
Wow. That's rough, man. That is rough.
Yeah. So
Well,
I mean, think about it. Would you invest in a company that their cash from operations is negative? Just think about it from that point of view. Because if your cash flow is in theory negative or very little, and you're turning your profits from, in theory, one-time hits, even though they're continuously, your biggest worry is, what happens if we don't get those one-time benefits? What happens if they go away? What's going to happen?
wow. So you think the S&P is digging that deep into it, huh?
Yeah.
Wow.
Because remember, think of it this way. Tesla may be big, it may be valuable, Elon Musk is the fourth richest person in the world, but the stock market is $15 trillion or $20 trillion. They are one of 500 companies. S&P is like, we're not, Tesla, you're not our client. Our client are the Wall Auto analysts and the investing public who are investing. And our goal is to get them the right information. We're not afraid of you. You know, some people are like, we're so big, you should just listen to what we want. And you could say, I don't think so.
Wow. Wow. Well, I'm shocked. Have you ever heard of a company not getting in and then getting it done later?
Yeah, I mean, it gets done. It's just like, it's one of those, we're going to bring you in, but there's some things we don't like about what's there, so can you fix it, and then we'll give you a second chance to get in. I kind of suspect that they're working with each other to figure out, it's that dance of, we don't want to give up enough, and they ask you to give up something, so where's that line going to be met?
Wow. Definitely makes sense. How long to clean up have they had?
I don't know. It could be a month or two, possibly. Who knows?
You don't think years because they've got.
No, it shouldn't be years.
Really?
Because you got to remember, this is an embarrassment to Tesla and their accounting. But they got to fix it and fix it quick.
Okay. Wow. Now, why a month or two? Why do you have that time frame?
I would say it's September, okay? And you want to have it done before the Christmas break starts. And Christmas starts in really at Thanksgiving.
Mm-hmm.
So you don't want to be coming in December, because December and January are squarely strange with the stock market, because you got people trying to accelerate their returns, decelerate their returns. Shifting is going up and down in December and January.
Mm-hmm.
So if they're not in by November, by mid-November, they won't get in until February at the earliest.
Mm.
So that's what I'm saying. It behooves them to work the behinds off to get in by February, get in by November, and put it behind them, or else you lose basically 3 months.
Mm. Well, that doesn't make any sense for November, though. You know what I'm saying? And the reason I'm saying that is they have to have 3 quarters of profitability, right?
Well, no, it's not about profitability. I mean, they can just put out an interim statement. They would still put in their quarterly report, and it will be effective as of a certain date, but they could put an indication that, okay, this is taken care of, we agree with them, and then as of this date, Tesla will be in. It's really at what point do they notify that it's going to get done, even if it's not being done until the end of the quarter. Because remember, we're in September. I doubt they have enough time to complete it. Well, you never know.
Mm-hmm.
I doubt they have enough time to get it in by the end of this quarter. But I'd be curious to see what their quarterly report looks like at the end of September. And that's going to be the indication. I would look at that and then compare it to previous quarters to see if there was significant variation. Because if it is, and the SEC signs off on it, the SEC can say, okay, we're done, you're in. You know, that's what you're looking at.
Mm-hmm. Wow. Well, it sucks, man. So what do you think is going to happen to the stock price next week?
I don't think, like Lemon said, it's so volatile, it's crazy. Mm-hmm. So, if people thought that they're not going to go in, that would be one thing. If people think, it's just, they're going to fix it, it's just a delay, but they're still going to go in, mm-hmm. That portion of the stock is going to be stabilized. I mean, the stock is still volatile in so many different areas right now.
Mm-hmm. Yeah. So are you expecting a big drop? Because the stock fell $30 when they weren't in. You know?
No, remember I said, I don't know if there will be or will not be. Remember I said, they're going to be volatile with big ups and big downs over the time frame. So, because there's so many different, the good thing for them is there's so many different things going on in the world right now. For them to have even like a 2-3-5% drop or increase on a given day or a given couple of days, it's expected. Mm-hmm. Because it's people shouldn't be running for the hills if they fall 5%. Look how much they're up this year. You see, mm-hmm. You know, it's almost like they're about due for a correction, mm-hmm. And maybe as much as like 10%. But think about it. It's 10%. And the person who just bought it this week or last week, they're going to get burned. Mm-hmm. But the people that bought in January, I lose 10%. Great.
Push back the computer.
I'm already. What is Tesla up this year? 80% this year, mm-hmm. already? Mm-hmm. So you're up 80%. They lose 10%. So okay, instead of being up 80%, you're up 72%. You know, that's what you're looking at, and so in that realm, a correction is would not be unexpected.
So let me ask you this. My estimate is that the stock price was about $1,500 before the S&P stuff was brought in. Do you think the stock will give back all of the pre-S&P gains and just go back to the fundamentals of the company, or does it stay in the range of where it's at currently?
It really depends on how the CFO handles stuff.
Mm-hmm.
It could be that they're going to keep stabilized. And once again, this is one of the reasons why a lot of people don't like to be public companies,
mm-hmm.
and everything else,
mm-hmm.
because you guys spend so much time and effort dealing with Wall Street that you don't really want to deal with, and have a department that's all they do.
Mm-hmm. Mm-hmm. So you don't foresee a huge drop in price, to right size it, because it may or may not get into the S&P.
It may or may not. I'll say this. I don't expect it to happen, but I would not be surprised if there's a 5 or 10% correction.
Mm-hmm.
But that has nothing to do. But that has nothing to do with the stock or with the S&P or other stuff. Is that it's a volatile stock and they've been on a tear.
Mm-hmm.
And you know what I'm saying? You can't go up forever.
Mm-hmm.
It's like just put the brakes on,
mm-hmm. correct
yourself back. Of course, if they drop 10%, everyone's going to act like the world is ending.
Mm-hmm.
But it's like, once again, I said, you drop 10%, that's to go to 80%. Something that's normal.
Mm-hmm. Mm-hmm. Wow.
And really what happens is you got a lot of up 2%, down 1%, up 3%, down 0.5%, whatever. That's been like up 2%, up 3%, up 5%, up 7%. They don't have the down 2% here, down 1% there.
Mm-hmm.
So a lot of times when that happens, all those 1% here, 1% here, 2% there,
mm-hmm.
they come all together. And that's the correction.
Mm-hmm. Mm-hmm.
Because it grew. And remember, you've got so many people that are, here's what I'm figuring out. You got so many people who are armchair traders. Now the economy's opening up and they're going back to work.
Mm-hmm.
Are they going to be spending as much time trading? And the question is, what does that do also? So, there's so many different variables out there that can affect it one way or the other.
Mm-hmm.
That's really what I'm thinking about.
Mm-hmm. Mm-hmm. Interesting. Well, it's going to be